In the past years, equity investment and trading has gained immense popularity as now more and more retail investors are participating in Indian stock markets due to its potential to deliver handsome returns. However, many investors have suffered losses or are unable to make the right bets as they either paid too much for the stock and lose some of their capital, or because they fail to spot the one that is available cheap, thereby letting go of the chance to make good money. This happens due to lack of knowledge about how to value a stock before making any investment. In stock investing, most experts will tell you about conducting fundamental analysis of the company before picking stocks. This means that you need to look into the financial records of the company and assess if its stocks are worth investing in right now. However, not everyone is a financial whiz to know what exactly do you look for while assessing the company and its stocks. Hence, today we bring you some of the fundamental areas that need your attention to ascertain the viability of the investment. While investing has 4 set of basic elements that investors use to break down the stock's value. So in this video, we'll go through and we'll look at what are the 4 commonly used financial ratios that can come to your aid to analyze a stock and make a decision. Now let me also tell you that although there is no right way to analyze a stock, these financial ratios can be a very good way to run a fact check on the company's health. So with that said, let's get started. So the very first one is the price to earning ratio. Well, the price to earning ratio simply shows how much the stock investors are paying for each rupee of earnings. This ratio can simply tell you if the company is overvalued or undervalued in the market. While PE ratio compares the price of the stock to the company's earnings per share or EPS over a 12-month period. This lets you compare the price you pay for a unit of profits from one stock to another. Now, to determine the PE ratio of the stock, simply divide the share price by the company's reported earnings per share. Now, for instance, let's say if a company has an overall earning of rupees 1000. It also has, say, 100 shares trading in the market currently. Therefore, its earning per share is rupees 10. So now let's also say if the company's share are trading at rupees 100 per share, then we get a PE ratio of 100 which is divided by 10 which equals to 10. Well, in simpler terms, you are paying rupees 10 for getting rupees 1 from the company's earnings. Hence, it is easy to deduct that if a company's PE ratio is higher, it is that much of overvalued. So now, are we actually looking at the ideal PE ratio of the company that you invest in? Well, the answer to that is simple and straightforward. You shouldn't be looking at the ideal PE ratio because you cannot compare the PE ratios as every company and every sector has different benchmarks. So now remember that whenever you're assessing the PE ratio of a company, then it is important to know the benchmark of the company and then assess its value accordingly. The next one is called as the price to book ratio. Well, the price to book ratio or PB ratio measures whether the stock is over or undervalued by comparing the net value, which is the asset minus liabilities of the company, to its market capitalization. Essentially, the PB ratio divides the stock's share price by its book value per share. Now, the PB ratio is a very good indication of what the investors are willing to pay for each price of the company's net value. Well, the reason the ratio is important to value investors is that it shows the difference between the market value of the company's stock and its book value. Now, remember, the market value is the price the investors are willing to pay for the stock based on the expected future earnings. However, on the other hand, the book value is derived from the company's net value and is more conservative measure of the company's worth. Let's take for an instance and let's say that the value of a company is say rupees 1000, and then let's say it decides to shut down the company and receive rupees 1000, but it also has to pay rupees 400 as a loan repayment. Also, let's say the company has asset which is worth rupees 200. Now, therefore, the total book value we get of the company would be rupees 1000 minus rupees 400 plus rupees 200, which is equal to 800. So the PB ratio helps as it indicates the company's inherent value and is useful in valuing the companies whose assets are more liquid, for instance, the banks and financial institutes. The next one is the price to sales. Now, price to sales or PS is the stock price which is divided by sales per share. While earnings and book value ratios are generally more appropriate for large companies with positive earnings, the price to sales valuation ratio is often used as a comparative price metric for the companies that do not have positive net value. They are often the young companies who are in trouble. Now here the revenue relies less heavily on the accounting practices than earnings and book value measures. Well, the last metric is called as the debt to equity ratio. Well, as the name suggests, this ratio gives you an overview of the debts and the equities of the particular company. It is calculated by dividing the company's total liabilities, which is debts, by its total shareholder equity. It can give you an indication of how much the company is running on loans when compared to the owned funds. Again, here there is no ideal DE ratio that you have to be looking at. It can vary with industries and sectors. Now, usually when a company has a lot of debt, then it is assumed that the company will find it very difficult to pay it back. Also, since the debt attracts interest, it will definitely impact the company's overall profit and loss statement and negatively impact the net income, leading to a drop in cash flow. The DE ratio thus helps the investors to determine if the company has a lot of debt or not. A higher DE ratio means that higher debt and vice versa. Now let me also tell you that, however, a higher debt to equity ratio does not necessarily mean that the company is running poorly. Often the debt is used to expand operations and generate additional streams of income. Some of the industries with a lot of fixed assets, such as the auto and construction industries, typically have a higher ratios when compared to the companies in other industries. Hence, it is very important to treat this ratio as a mere indicator of the amount of the debt a company has with respect to its equity alone. So, these are some of the 4 metrics that you can use to value stocks. Value investing is one of the important popular investing strategies today. Pioneered by Benjamin Graham in the 1920s, this strategy has led to wealth for many and has been a catalyst that brought many investors, including Warren Buffett, to riches. The financial ratios above that we just discussed were all designed to tell you whether you are overpaying, underpaying, or getting a fair price in the stock market. By using them as part of your research when you're making any kind of investment decisions, you will definitely increase your chance of success in the future. So I hope this video was quite helpful to all the smart investors who are looking to make huge profits by investing in stock markets in the future. So if you have liked this video, do not forget to hit on the like button, subscribe to our channel for more such financial content, and do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise and break free.